Hello, my name is Eddie Tofik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Paris milling wheat. There had been here one continuing dominant pattern for quite some time here. A quite large pattern that 15 weeks ago took a break on the downside. It is of course the dark blue highlighted late August 24 to late February 25 ascending triangle pattern. This pattern had the requisite combined 5+ touches and is made up from a lot of smaller patterns within it. But the main pattern can be clearly seen on my daily chart. 16 weeks ago I laid out targets below for this pattern. I quote, primary target X would be in the 226 zone, the secondary hard to reach target X1 down in the 194 even zone, end of quote. 14 weeks ago the market reached the primary target X, pushing down below it. However, we had a stall in the movement lower during the first part of March, prompted by the market trying to test down towards the 50% absolute Fibonacci line at 219. Now please remember this 219 level and the 50% absolute Fibonacci line, as it will come up again soon. This action back then became very crucial to what happened next, beyond the obvious significance as being a 50% Fibonacci, absolute Fibonacci line. You see, it had importance because this level helped hold up prices back in November and early December last year, and also eroded the bearish incentive back in August and September last year as well. The reactionary rise we saw in March only managed to move up to the medium moving average overhead, currently at 221, not even testing it, but rejecting further upside pressure, and we dropped lower after that, more or less down to lows that had not been seen since March last year. Anyway, 15 weeks ago I amended the still open further targets below into a secondary hard to reach target at 205 and a tertiary target X2 at being an even harder to reach target down at 194. I asked the question back then, and I quote, "The question still remains as to whether prices will take this time to form a possible bearish halfway hesitation, or will they recover further? The latter seems unlikely right now, and the former, well, it is too early to say, though it might comply with what is going on in the other grain markets," end of quote. I added 9 weeks ago, and I quote, "Comply? Well, the market did, as we've dropped down through the 50% absolute Fibonacci line and shown a new close-in target X4 for the bearish halfway hesitation down in the 206 zone, which I have since finessed to the 208 zone. This is the most immediate opportunity on the downside," end of quote. 6 weeks ago prices reached the target at 208, and 3 weeks ago they reached the target down at 205. This just left the tertiary and much harder to reach target X3 down at 194, still open. I am usually loath to downgrade or retire patterns or targets. I suppose this is due to my conservative nature about the markets, but last week I was considering retiring the final and ultimate target X2 below at 194, and this week I have not done so. Part of me wishes to keep it, so I may bring it back again at some future date. So I'm really suspending it rather than retiring it for now. In more recent action, 3 weeks ago prices pushed down up through the 50% absolute Fibonacci line at 219 and the green short medium moving average currently 213, and even the May 23 low at 221. However, by 2 weeks ago it was clear the market had not managed to stabilize over any of them, and we moved back down to resting just above congestion on the downside at 211. Further up, the medium moving average is slowly entering the frame, and prices overall remain below the 50% absolute Fibonacci line. Then this week we had a break below the congestion at 211, though we have since hesitated. We nevertheless have the opportunity to look at the whole mid-May to date action as a possible small bear flag, with potential down to where target exits in the 205 area. This idea may change, but that is what it looks like right now. However, there is a nice symmetry to this idea, as it means the gap in May from 2025 will be filled in. So overall, same as last week, and I quote, "Keep an eye on the big gap below and overhead on the 50% absolute Fibonacci line, plus the overhead declining medium moving average and a long moving average above that," and that's currently at 226, end of quote. Minneapolis wheat. We had one key pattern to look at here in the recent past and a number of newer patterns and levels to discuss as well. The key pattern is the previously highlighted sideways triangle, created by what is now the July 23 to May 24 downtrend and the March to mid-May uptrend. After some hesitation over the last few weeks, prices finally pushed lower 4 weeks ago, down to the slightly realigned September 2019 to date uptrend, currently at 574. This was all before a changeover gapping moved prices back up again. Now there is no bearish half hesitation to consider here as is seen elsewhere, nor is there a 38.2% absolute Fibonacci line nearby, as that is down at 537. So it was a straightforward attempt lower, though we also had support down here, down at 578, and in the congestion seen from November 24 to January 25, between about 585 to 611. In the end, prices did not manage to reach the targets below and have retired them. The subsequent move back up from the September 2019 uptrend hesitated for a bit in late May, resting just over the medium and long moving averages, currently 623 and 616 respectively, and creating a small bullish half hesitation. That Monday last week reached its target on the top side. In the process, prices have pushed up over the April 24 low at 635 and have been eyeing the overhead August 2028 high at 650, plus the nearby congestion at 652 and the 2025 high made back in February up at 659. Now, I said last week, and I quote, this action could be seen as yet another small bullish half hesitation with potential up to the 650 area. However, once there, we will have to contend with the high for 2025 made back in February, just under 660. End of quote. In the end, prices did not try higher, but instead moved lower, though unlike the other US grains, did not really create a reverse head and shoulders pattern here, nor a double top pattern, rather instead opting for a small horn top pattern formed over last week and the start of this week. Now even this small horn top has some targets, and it reached the primary target one in the 622 zone easily enough, but halted before the harder to reach secondary target in the 615 zone. No doubt put off by the rising long moving average that's below, currently at 616. And also the medium moving average currently nearby at 615, and even the short medium moving medium moving average below that, which is currently at 612. So where does that leave us? Well, we have seemingly good and slowly rising support below from three major moving averages, aided by the old October 2018 high at 611 and the April 2021 low at 606. Though I personally am dubious about those two, especially the April 2021 low. Meanwhile, on top we have the April 24 low at 635, which is an abrasive to any move higher. It'll rub it out slightly, or rub it down. Plus congestion at 644, and then the August 2018 high at 650, with nearby congestion at 652. It would not be unreasonable to see prices travel between these supports and resistances, but at some point in the future prices will become constricted and may take a break outwards, though I'm not sure just yet when and in which direction such a move may take. London UK feed wheat. There continues to be here on this daily chart, even now, these many months, close to 1 year even, only one major significant pattern here, something we have not seen in the other grain markets, and that is the bright red late May to early July 2024 bearish shift pitchfork. The market in late February this year reasserted the dominance of this pattern, with prices breaching, then repairing an attempted break higher over the bright red upper time, which is currently at 172.30, back in late January and early February. Add to this the earlier this year narrow mix overhead of all the moving averages, though they are now separating out, as well as the 50% absolute Fibonacci line at 180.5, and you had, still have, an area overhead that, as I've repeatedly said for months and months, has been brewing up for a significant move which happened, or should I say started to happen, over late February and into March. I had been, as I said 26 weeks ago, so half a year ago, and ever since, and I quote, Even now, still looking for that better pattern to appear, and until that shows up, I will continue utilising the bright red bearish pitchfork, end of quote. So my point has been, and still is, that the bright red bearish pitchfork was and is, after all the temptations of other patterns, still the one key pattern I was looking for all the time. This leads me to my final 4 points, and 3 of them were something that I noted in it's not so recent now, in my annual commentary made early this year on London Feed Week. Firstly, I saw there the potential for a very large May 23 to date cat's ears pattern. Now this is a bearish pattern akin to a double top formed after a big fall, such as the fall we had earlier in 2023, as well as an even longer term second pattern, an August 2020 to date very large head and shoulders top pattern. These 2 super long term patterns are still live, and they both rely on one single feature, and that is their common neckline, on my daily chart currently at 167.80. For most of March, prices slid along the top of the support from these pair of necklines. However, 6 weeks ago, prices dipped again below the neckline, setting up the opportunity for a recent bearish halfway hesitation. Potential target X down in the 151 even zone, and at the same time making the lowest low and low closes since March last year. Unfortunately, time is running out for this target X down at 151 even, and I may well retire it soon unless I see a constructive move lower, and soon I'll be speaking more on this as well. The third feature is a little more longer term. It is the March 2016 to date twice recently finessed, dark blue uptrend, currently at 154.60. I said 6 weeks ago, and I quote, "It looks right now as if we are finally breaking below it, as well as pushing down through the congestion between March to April 2019 between 161.95 to 165.75. End of quote. Well, we finally did push below it, as well as below the bright red middle time, currently at 154.60, though we've since not stabilized below it and have spent most of the last 4 weeks above it. We do have support below at the February 24 low at 154 even, which held prices up 3 weeks ago, and the March 2024 low at 153.65. I did say 4 weeks ago that it would be interesting to see how the market treated these 2, and it was, as we saw 3 weeks ago, it was to be with a weekly key reversal up right at the lows of the market. There has been no follow through higher since then, with prices staying within the body of the earlier weekly key reversal up until this week, and I'll deal with that shortly. Now this comes to this week's actions, and we are set up now for this week to be a weekly key reversal. Thus, if we close tonight either over 159.05 or under 157.20, then we're beyond. Right now we're looking at a weekly key reversal down, which ties in with a lot of the other bearishly generated patterns here. Now, going back a little bit, I've said here repeatedly there was one major possible severe criticism of the 2 earlier mentioned necklines, and that they had been previously breached, and some would argue broken. However, I counter that by saying that I transposed these from my longer term monthly charts, and whilst on a daily and even on a weekly chart they may appear breached and broken, on the longer term monthly charts where they really live, they did look still somewhat valid. And as I've said repeatedly, and I quote, "I would not take these as cast iron lines in the sand that should not be crossed, but as a longer term strategic patterns that we should bear in mind and occasionally bring a closer eye upon, such as now." End of quote. I added 6 weeks ago, and I quote, "This week is the first week in quite a while when I really think we have broken the back of this support. We have not only had a significant monthly close below these key necklines, but we also did it with a monthly key reversal down. Now, 1 month does not make a major pattern change in my monthly charts, but it does set up the situation to see if May and even June will follow through lower. Watch this space." End of quote. Now, I still stand by those words. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Toftbig and ADM Investor Service International Limited. And here comes the final important bit.